Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This month, we're excited to be joined by Tim Bray, Managing Director of Alternative Investments and Senior Portfolio Manager at GuideStone Financial Resources. With more than $23 billion in assets under management, GuideStone is recognized as one of the nation's largest faith-based mutual fund companies, offering a comprehensive range of services, including financial planning, retirement solutions, insurance, and investment management. Over the past 19 years, Tim has been instrumental in building out GuideStone's alternative investments platform across institutional accounts, overseeing approximately $3.5 billion in assets that include both internal capital and external client investments. Tim, welcome to Private Capital Call.
Thank you. Good to be here. Appreciate your time.
So the timing of this conversation, which I'm excited about, is, we're early March and things have changed probably since even you and I met not that long ago and had some conversations about the current investing environment. Things are happening, particularly in the U.S. and particularly at the government level, very quickly. Maybe we can just start with thinking about the state of the macro environment in the U.S. and any kind of themes that you took away from 24. And frankly, what are you seeing now in terms of the latest moves in markets and the economy and rates and so forth?
Sure, absolutely. I know we talked about, what had happened in 2024 that seems like it's far in the rearview mirror. Of course, I think a lot of us were surprised by the market action back then. That a second year in a row of the S&P 500 up over 25% is a pretty rare occurrence. I know I didn't see that. I don't know of anyone that forecasted that. And we had another negative year in bonds last year with the global aggregate down almost 2% and sort of a lost decade for bonds. So I think financial markets, had some surprises last year. And of course, this year, we're starting to see some more surprises. You talk about what's happened in markets now. One of the things that I had predicted going into last year was that we were going to see the inverted yield curve be one of the longest in history, which we saw, but that it would finally uninvert, and it did in December as the Fed started finally cutting rates after an extended pause by they cut 3 times at total 100 basis points. And we finally saw the 3-month trade below the 10-year. And now with this recent volatility we've had in markets these last couple of weeks, Randy, right? We re-inverted again with the 10-year trading back below the 3-month, trading as low as 415 on recent volatility. I certainly didn't see that coming. So certainly a lot of surprises in markets these days, as you mentioned.
Well, as alternative investment manager for your platform, this is the kind of thing that we live for, right? Because the old 60-40 model, bond equities mix that over the last 10, 15 years has begun to erode a little bit in favor of some kind of permanent allocation to an alternative strategy for the very reasons that you just spoke to at this introduction, which is the sudden changes in the liquid markets based on expectations of whether it's policy, external events going on. I guess in terms of how you think about the market for 2025, how do you respond to all these changes in terms of your own thinking through allocation and what you focus on and what the benefits are in this pretty volatile environment that we've all of a sudden been welcomed up to?
Yeah, that's right. And some of this volatility has ended certain trades that have been quite profitable in recent periods. Of course, U.S. exceptionalism was a huge theme last year. I personally didn't see it as continuing as strong as it did. We all know the Mag 7, was up 67% last year. But here with the tariffs and some of the headline events, we've seen a reversal of some of that. So it's paid to finally be invested globally into international markets where, you've seen a double-digit dispersion between the U.S. equity markets now and, European markets, for example, with some of that U.S. exceptionalism trade coming off. So that's been one of the things we've been positioned right for, being a little bit overweight international. That's not been a winning trade, but I think going forward, the U.S. can't outperform forever by double digits global markets. And so we've been positioned to take advantage of that. I think, I mentioned obviously fixed income markets on the public side have been challenging for quite some time, particularly if you had more duration. It's been a brutal opportunity set and performance for fixed income, although most portfolios need it for diversification. But at least now yields are better and healthier, and you're starting to see the benefit of fixed income in a portfolio. And so glad to see fixed income provide yield and return again to portfolios in this market where, equities are now negative in the US. There have been offsetting gains on the fixed income side.
And speaking of fixed income, one of the things that I watched with interest in the early part of the year was the seeming dissonance between where treasuries were headed from a yield perspective versus the spreads on corporate bonds, for example, which were at their tights. And it seemed to me like, and I'm sure from a treasury perspective, it was the very nature of what was going on at the US government level in terms of policy, as opposed to the capital markets, where the corporate bonds were probably adjusting to this fact that you had pretty benign environment for corporate issuance, right? And so my guess is that, though it seems in the last few days that has eased a little bit, that treasuries, to your point earlier, are coming back in line with what's the perception of the risk going forward. Am I reading that right?
Yeah, that's right. I mean, I think we saw an exceptional dip down in yields and sort of trending back higher, which is what we would expect. I mean, inflation is still alive and well and an issue. The Fed's on pause for an extended period of time, probably till the summer. And economic growth, despite some weakness in recent soft data, is probably, still strong enough to support this economy. So I don't think we're going to see a lot more strength in terms of yields continuing to try to push even lower. So some normalization after a little bit of a risk off makes sense. And of course, as you said, spreads are exceptionally tight because corporate balance sheets by and large are healthy and, risk taking. Despite some of the, I guess, recent days, there's a lot of volatility as we're trying to sort through the headline risk, right, of ever-changing Trump positions on things. At least his negotiating is kind of out in public, right? So that's creating more headlines as Trump tries to use tariffs as a negotiation tool, amongst other things, creating volatility across yield. So we've seen a remarkable amount, compared to history, of volatility in fixed income.
And where do you think the worst case scenario is on tariffs? It does feel like the markets are seeming to taking this more seriously. Or early in the year it was seen as a more of a negotiating tactic, but it's feeling more real. And again, that may or may not be the case, but certainly markets are responding as if they're more real. And particularly, I think in the M&A market, it feels like certainly some of our clients are hesitating a little bit, because particularly if you have a Canadian asset that you're looking to trade, what tariff level are you putting in your projections? Is it 0, is it 10, is it 20, is it 30, and that makes a big difference in terms of valuations.
Well, clearly, I mean, tariffs, if you really did have your 25% tariffs on Canada and Mexico, that would be an absolute disaster for those economies, right? I mean, that would be sort of an immediate recession type conditions for those countries, and certainly a hit to GDP for the US. I think that would be the worst case. That doesn't seem to be, given delays, et cetera. That's not my base case, is that we see that type of level of tariffs go on. I think the worst case scenario, though, is that tariffs, beyond a negotiation tactic, are a tool to truly rebalance the economy and lift income. So to the extent Trump does put on tariffs, now they've been kicked back to April, apparently, as of this afternoon. But to the extent they do go on and stay on for an extended period of time, so let's call it several quarters, two or three quarters or longer versus maybe just a month or two, then I think it could be a meaningful reset in terms of markets and expectations. And to your point, the biggest fear is that it hits confidence and it hits business investment, and people aren't willing to spend until they understand what's going to happen with the tariff dynamic. But if Trump's looking to rebalance the economy and wants the automakers to move into the states, that takes time. So how long is he going to leave tariffs on until sort of the rebalancing of the economic conditions that he wants to see occurs? Or once that sort of begins, he takes the tariffs off. So it's really, the worst case is it stays on for longer than just, weeks or months, more like quarters or years. And then, yes, I think it would be a meaningful reset in both growth and financial markets.
So let's take us on a tour, Tim, if you will, of your world of alternatives. Our listeners are, I think, keenly interested in how do you think about the asset classes within alternatives? How do you play them in your portfolio? What are the kinds of things that distinguish real estate from private equity, from private capital, from whatever other things are in your playbook right now?
Sure. I mean, first I'll say, we are strategic asset allocators, and we're also client specific. So every portfolio is going to look different. We're going to manage the investment objectives, constraints, risk tolerance of each individual account. That being said, I would say that our asset allocation centers kind of on, broadly on three pillars. One is we've got to have the right macro view of the world. So we spend a lot of time thinking about what investment themes, investment opportunities, and risks that we want to take part of in portfolios. Secondly, we've got to have an assessment of the attractiveness of the various asset classes, like you mentioned, and the risk return outlook of those asset classes. And then thirdly, we want to invest with top tier managers in their area of expertise. And if we can get those three right, then we think we can put our best ideas into portfolios appropriately. When it comes to alternatives specifically, we think that's an area that we can really differentiate ourselves by getting access to best in class managers and funds. And for that reason, we do typically, like to have a sizable endowment type allocation to alternatives in portfolios where they have the tolerance from an illiquidity perspective to do so. And we think alternatives really gives us the opportunity, to provide the most robust alpha opportunities, particularly relative to public markets. There's simply much greater return opportunities there. Secondly, obviously enhanced diversification. And then lastly, the potential to really build much more consistently returning portfolios by dampening volatility. Private credit in particular plays a foundational role in that. And that private credit is one of those asset classes where you can really get a substantial yield advantage relative to fixed income and provide kind of stability and downside protection to portfolios if you put a healthy slug of private credit into your portfolio.
Well, let's dig into that because you've been doing this for almost 2 decades. At GuideStone, private credit has obviously expanded, become more sophisticated. The evolution of the asset class has included now more subspecialties within the umbrella of private credit. What are you thinking now in 2025 in terms of what are the things that are attractive in specific sub-strategies, such as direct lending or special situations or other things? And how do you view some of the risks that some talk about in terms of more competition and spread compression and so forth? Walk us through some of your thinking on that.
Sure. Of course, with any asset class, there's risks and pitfalls. I think some of the media attention around this bubble in private credit is overblown. Personally, I don't really see it in the areas that we're allocating. There's plenty of middle market companies and plenty of opportunities to allocate risk. I would say as we think about the opportunity set in private credit, I think there's lots of great opportunities, particularly as the asset class, as you said, continues to mature and expand and provide more opportunities to investors. I will say, given some of the spread compression you have seen, we try to avoid as much of that as we can. Number one, we don't really go for beta in private credit, right? So we don't just want to be with an allocator that is a volume kind of underwriter doing as many deals as they can. We really generally stay away from just sort of plain vanilla, straight down the fairway where, maybe you're at SOFR plus 425, right? We're looking for a little healthier spread where we can. we'd like to allocate to managers that have a sourcing advantage, that've been in the business, they're doing repeat deals, they're doing deals where there's something about the deal that requires either speed of execution or complexity or hair in the deal where you can get more spread when you have a manager that knows what they're doing and able to appropriately underwrite deals that have some level of complexity. We certainly want to invest with managers where we can that control the paperwork, right? I mean, that's one of the key advantages of private credit, right? Is the control. It's that if you can be with those,
control the paperwork. I have to remember.
Yeah, if you can be with the lead underwriter, right, that is able to has their paperwork in place that they've worked with, and so what you're getting, and what's changed, right? We don't want to be with cov-lite, opportunities. We want there to be ideally, the covenant protections and the things that these managers have been able to negotiate and incorporate into their paperwork and stick with their, there's always some give over time in terms of what you can get away with in different markets, but we want managers to stick with what they've been doing since they can and with their convictions, and managers that have managed through a market cycle, and these are ways that avoiding some of the risks in the credit markets by doing those things.
One of the elements of this evolution is liquidity, right? Because you can see some of the very large asset managers thinking of private credit in the same way they probably would like to think of public credit or frankly anything that's liquid. And particularly as the retail market looks at the asset class, there's, I think, an urge on the part of managers to make it look liquid as possible. Talk to me about how you think about liquidity and what's obviously an illiquid asset class, and what are some of the pluses and minuses?
Yeah, you're right. Private credit's an illiquid asset class, and we try to stay away from trying to change into something that's not, right? It's illiquid, and it doesn't become liquid just because you put it in a fund that gives you liquidity terms. But that's definitely an up and coming theme. There's more and more evergreen funds all the time, or interval funds offering elements of liquidity and sometimes holding, public securities or cash and other things in order to try to provide the liquidity. But you got to be very careful, right, with making sure you understand that it isn't a liquid asset class and not count on liquidity that's not there, or have a basis risk between the liquidity offered by the fund and what the fund can actually provide. Because then if everyone tries to go for the exits, you can find yourself in trouble. And I don't know that private credit's really been tested, right? And as you get more and more flows in there and retail flows in there, what is going to happen if everyone wants out of one of these private credit funds trying to offer liquidity? I think there'll be some potential issues there. So rather than making it something it's not, we focus a lot of time on liquidity. So, commitment pacing is very important for us. We build our own custom J curves. We got to understand, what is the cash flows over the life of the funds going to be like. We seek as much information from our managers as we can. We ask for them to provide us what they expect cash flows to be. We ask our managers every quarter to give us updated cash flows for the next 2 years, because we're constantly making sure we understand, when loans are likely to roll off or extend, and it's changing, right? I'll tell you, these last few years, there's been a lot of extension in terms of funds, et cetera. And so what was an asset class where you thought you'd get your money back, in 5 to 7 years, we're learning is not the case, right? They get longer and longer. So we spend a lot of time understanding that. And of course, overall portfolio is going to have its own illiquidity limits and considerations when allocating to privates in terms of how much it can hold. But certainly understanding the distribution profile is very important to that equation.
Yeah. One of the things that I've noted as well in this expansion of the asset class is the revival of asset-backed finance. I thought that was just a creature of the 70s, the Heller Financial, GE Capital, CIT era of asset-based lending. But it's come back with a vengeance, just in terms of, I think, and I'm sure a lot of this is because it's an asset class that's coming out of the banks. It's probably, I think, anywhere based on estimates, $3 to $5 trillion worth of various types of securitizations that tend to be now on the more consumer side. And I think that's part of the attraction, because it's a diverse asset class away from sort of the commercial industrial world. But how do you think of ABF? Is it something that plays in your strategy and anything else that's new that intrigues you?
Yeah, I think it's an intriguing area we're looking more at. It's a way to diversify away, like you said, from just the pure kind of corporate lending. I like the versatility and diversification that they can pull together many different pools of collateral in a portfolio and provide you a lot of diversification, right? Because everything from home loans to auto loans to even some of the hotter trades when you're talking about data infrastructure, tech lending, things like that. There's just a lot of options for collateral pool. So I do like asset-backed finance opportunities that can give you a diversified way of loans against many different types of collateral, and that provides you a degree of protection and certainty against a downturn. And so it's certainly an area that we haven't done a lot of investing there, but it's an area where we're looking hard at making sure we understand. Personally, I think anything that is coming out of banks that banks have long done and it's migrating to private markets is probably an attractive, opportunity to take advantage of.
So as we wrap this up, and this has been incredibly interesting, Tim, from your seat for the rest of the year, what are the two areas, one that you're most concerned about as you look forward this year? And then the second would be, what do you think will end up surprising all of us when we get to the end of the year about 2025? So most concerned, and then what do you think may be most surprising?
The most concerned that I am, frankly, right, is that we've priced in Goldilocks across a lot of asset classes. Mm-hmm. Recession risks coming into this year, a lot of people had it in that 0 to 10, 15% range. And just this week, we've seen Goldman Sachs and some of the other banks lifting their recession risk to 20, 25, 30 type percent levels where it's real again. And I can tell you that's not priced into markets. No one right now is thinking, that could continue to trend higher or that recession is anywhere in the cards. And so I think the biggest risk this year is that we get a surprise weakness in the economy, and that's got to be reflected in markets, and we're nowhere near that, given we're still near all-time tights on the credit spreads, and we're near all-time highs in equity markets, and that concerns me that the downside could be much greater than the upside from here if we get geopolitical events or other things that weaken markets from here. And I think on the flip side, from an opportunity perspective, with volatility and a reset in markets comes opportunity. So I'm fairly optimistic this year that it's going to be a good year for private markets to allocate capital. Real estate's been very challenging, but we're probably through most of the pain there. So private equity's been sort of challenging and has had a big reset. So personally, I think starting to commit capital and private equity and private real estate is looking a lot more attractive. I think hedge funds are going to be able to, in many cases, take advantage of both the higher cash rate environment and also more volatility and uncertainty in markets here. And we've seen that. So I'm optimistic about the alpha opportunities out there in this market.
Yeah, well, that's great. That's a great conclusion to what's been a really interesting tour from the desk of Tim Bray. We look forward to checking in with you regularly to see how you're doing and how the some of these predictions and elements of the markets turn out. But Tim Bray, Managing Director of Alternative Investments and Senior Portfolio Manager at GuideStone Financial Resources. Tim, thank you so much for joining us at Private Capital Call.
Randy, thank you for your time as well.